bye, 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 bye.
I know I'm a grifter, strong man. You could lick your hand and smack me in the nutsack. Thank God for Tesla, my Tesla, and you, strong man.
Ooh, boy. Welcome back to Strongman Personal Finance. My name is Christopher Belli. I'm a certified CPA accountant. I'm a fake boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I'm going to give you a proposal, ladies and gentlemen. Do you hate waiting for income to hit your bank account? Do you hate going to work every day? Would you like an investment that deposits a monthly check into your bank account? And you don't even have to work, bro. Passive income. Well, I got the investment for you, ladies and gentlemen. Certified and pumped up by none other than Joseph Hogue, CFA. Oh, I'm a CFA, bro. Better than you. This investment is QYLD ETF. It's the Nasdaq 100 covered call ETF. Now, I'm going to show you what this ETF's all about, and I'm going to show you why it's a massive freaking joke, and why you dividend clowns, you income clowns, make me freaking laugh like none other. Man, I love pissing off dividend people. Dividends, you don't understand, bro. Yeah, shut up. All right, let's go ahead and look at the 5-year performance of the Global X Nasdaq 100 covered call ETF. And we'll go into more details in a second. So currently the share price, the ETF price, is $16.84. Really doesn't matter. And over the past 5 years, despite having Nasdaq 100 in the name, its total return has been negative 30% over 5 freaking years. But strong man, that's because they have dividend distributions. They have income distributions. And obviously that reduces the share price. I mean, yeah, that's true. But let's read a little bit more and look at the total return. So here we are on the website. It's sponsored by Global X ETFs. Why would you consider QYLD? And a lot of people like this on YouTube because I'm not going to say you're dumb, okay? I'm just going to say you're probably ignorant on the concept of total return and what you're actually investing in. I get all heated and sweaty when I do these videos. So why would you consider QYLD? Number one, you're a clown. No, I'm just kidding. High income potential, because it's all about income, right? QYLD seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. And there's a tiny little note right here. I don't know if you can see it. Covered call writing can limit the upside potential of the underlying security. No way. So basically what a covered call is you are writing a contract where you are stating that you have the obligation to buy lots of 100 shares of an underlying security if you are exercised by the person that has bought the contract. It's simply a gamble on short-term volatility. It has a monthly distributions. Ooh, monthly income. That's like work, right? QYLD has made monthly distributions 8 years running. Wow, it doesn't matter how bad the total return is. If you get monthly distributions, that's all that matters. And efficient options execution. QYLD writes call options on the Nasdaq 100, which is a very volatile index. And that index has had massive outperformance. And we're going to go look at the index in a second, just the underlying index. It's a ridiculous index, saving investors the time and potential expense of doing so individually. I mean, that's true. Most people don't have the ability to write freaking covered calls because you'd be very concentrated in your portfolio. So let's look at some of the fun details. They got 6.92 billion net assets under management. OMG. The inception date was December 2013. Let's see if they have the expense ratio on here. SEC yield is 0.32%. The 12-month trailing yield is 16%. And the distribution yield is 13%. 13% distribution yield. Now, let's look at the total return here. Well, the average annualized returns. Over 5 years, the fund's NAV has had a total return when you factor in the freaking dividends or the covered call distributions of 5.41%. And we're going to go compare this to the index. Now, let's look at the top holdings here, okay? Now, remember, a lot of these stocks have just blown it out of the water in the past 5 or 10 years. So if you think about it, you're writing covered calls on, and you're basically setting yourself up to be obligated to have to sell and deliver lots of 100 shares of some of the most volatile and best performing shares in the world in the last 10 years. Let's look at the assets under management. So these are what they are writing covered calls against. Apple Incorporated, Apple Inc., 13.64% of the portfolio. One stock. The next one, Microsoft, 10% of the portfolio. Oh, that's not concentrated. Just buy it, bro. Amazon, 7%. Tesla, 4.6%. And Alphabet, Google, roughly just over 7%. I mean, this is the most concentrated, ridiculous portfolio I've ever seen. And on top of that, you're writing covered calls against it, which means you might be forced to sell all this stuff. Now, the expense ratio, where is the expense ratio? It's somewhere on here, but the expense ratio is 0.6%. 0.6%. VT is 0.07%. So the expense ratio of this is like 8 or 9 times more than VT. And there's also another investment you could buy. It's called QQQ or QQQM, which is just the Nasdaq 100 with a fraction of the expense ratio, and you don't limit your upside. So let's go look a little bit more in detail on their option strategy. What do they do? What do the covered call ETFs do? They buy the reference index components, write monthly out of them at the money index calls on 100% of the fund's portfolio in an effort to maximize income. So basically the calls they're writing are the strike price is currently what the index is trading at. So there's risks to each one. If you write an out of the money call, you're probably going to get less premium. If you write an in the money call, you're going to get more premium. If you write the at the money call, you're going to get somewhere in the middle. And I'm not even an options expert. I don't do this crap, but I know some of the basics, okay? And it's just clownish gambling. Call position sells at the money covered calls on 100% of the assets. 100% of the upside is forfeited. Remember, this is one of the best performing indexes ever. Put positions, none. Fund has all the downside risk of the index. So it has none of the upside and all of the downside. Oh, this is so stupid. Options contract length. So they write monthly at the money call options. So if the underlying stocks rocket up, oh, guess what? Boom, you get exercise. You missed all those gains. But they have monthly distributions. Oh my God. What a freaking joke. Okay. I mean, look at this performance. I think they have the expense ratio on here. Oh, it's got lots of income. You're so stupid. Total expense ratio, 0.6%. And we're going to compare this to QQQM in a second. Look at the top holdings. Look how concentrated this clownish ETF is in. And then look at the 5-year performance, okay? I'm guessing this must be the compounded performance. And they're saying here 6.4%. I don't know when this thing exactly came out, but you compare that to QQQM. Let's go look at QQQM. So this is QQQM, which is the QQQ. It's the Nasdaq 100, but it's got a slightly lower expense ratio. And you can see all the yields are a fraction of the cost, a fraction of what QYLD, because they don't write covered calls. They just buy the stocks in the underlying index. It's 100 of the largest non-financial stocks on the Nasdaq. Okay. Look at the 5-year performance. And I'm not saying like past performance, future performance, blah, 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 blah. But if you were sitting in the past and you were like, I don't know, I want to buy QQQ or QQQM, but at the same time, I want to, get income because dividend income, passive income, that's all that matters. Look at the 5-year return. Nasdaq 100, 18%. 18% versus this stupid covered call strategy of 6 6.35%. What freaking clown is going to buy this thing? And I bet you get taxed to death. And I'm actually going to do a video on taxation of stock options because y'all need to see this freaking garbage and how ridiculous it is. So overall, this is the most ridiculous ETF. If you're a clown and you just want like a monthly check, oh my God, I got my check. Passive income. I mean, and you guys make fun of VT. This underperformed VT. Oh boy, what a joke. Let's see some comments. See all you angry freaking, but it's got income, bro. You know, I should start pumping these ETFs. I get like 1 billion subscribers. La Tesla. Strongman is declaring war on dividend people. Dividend people piss me off. Why are people so against buying a total market index? I don't understand. Just buy it all. Buy the haystack and let it ride for 30 years. It's like, oh, God. QYLD ETF is a 13% dividends return, maximizing the compound interest. I mean, I know you're trolling, but it's like, yeah, but the ETF's price also went down. So your total return ain't 13%. Yeah, it says 13% right there, strong man. You're so stupid. Nusi. What is Nusi? I've got a few thousand each. It was a mistake. I'm sorry. Lesson learned, I guess. Well, I bet the expense ratio and turnover rate is sky high. Yeah, I didn't even see the turnover. I guarantee you the turnover is insane. 0.6 expense ratio when you could just buy the index itself and it's 0.15. And I don't even own QQQ, but if I was going to buy one or the other, well, I don't know. It really depends on if you're like bearish or not on the Nasdaq 100 going forward. Because, you know, if it's just going to keep crashing and crashing, I mean, maybe this one will outperform, but I'm not even touching QQQ. QYLD was paying 17% dividend. It limits the upside, but has unlimited downside. Yeah, it's the dumbest thing I've ever seen in my life. And here's the CFA. This guy's a CFA. I'm not a CFA. Okay, I'm a CPA. I do accounting. There's a CFA. Oh, this is a good dividend income ETF because taxes. I like paying taxes. You're just jealous you're not part of the bow tie nation. Yeah. What kind of freaking clown wears a bow tie on YouTube? It's in front of you. And the dividends are considered as ordinary income too. Oh my God. But you know, nobody will watch this because like I'm not going to tell you I'm not telling you it's going to 10x, bro. Monthly income, it's good. Whoever preached QLD is like you're on cocaine saying Jesus is still alive. He is still alive. I QYLD for a year before I realized it was garbage. Thank you. You're welcome. Total market index funds. Chris, your wife let you out of the garage. I'm actually at my parents' house this weekend. I don't have a nice office like this. Dig this type of content. Keep dropping knowledge and calling out bogus advice. And please, for the love of God, don't ever lose the squeal. Of course I won't. It's my signature, bro. Make a video on how to read balance sheets. Why do you have to? It doesn't matter. Okay? Just buy Tesla. Just buy crypto. QQQ is far better long. I mean, yeah, in my opinion, I would rather buy QQQ than that garbage. Joseph Hogue he's a CFA. That's the freaking sad thing. And here I am, some freaking, you know, relatively inexperienced accountant. And it's just obvious to me what a clownish joke this is. I like his bow tie. Can you check out cows? Sure. How do you explain Warren Buffett recommending people out 90% of their money in QY? That's funny. That's funny. Hit the like. Yeah, everybody liked the video. All right, that's it. If you guys have any more ETFs you want me to look at that do like clownish things like this, just drop it in the comments of the video because there's so many out there I don't know exist. I mean, I really just know VT and some of the like basic indexes, and that's it. I don't sit around like, oh, how do I get monthly income so I can pay lots of taxes and underperform the underlying index? I don't do that. All right, guys, have a wonderful day. Cheers.